Howdy, Jacob here. Today we're looking at Lattice Semiconductor Corporation in the semiconductor and equipment industry. See that they were founded in 1983 with 10.7 billion market cap. They have 10.6 billion enterprise value. Over double the growth in the last 9 years. Return on invested capital the last 3 years has grown substantially and is currently 39%. Gross margins and operating margins have both expanded very quickly and very heavily. We're seeing 70% gross margin, 30% operating margin, very impressive. Balance sheet, they have 128 million cash on hand with zero long-term debt, zero short-term debt, and only 149 in total liabilities. You're looking at a very safe company from a balance sheet perspective. On the cash flow, we see that there's a bit of reinvestments, not a lot of acquisitions, quite a bit of share repurchases and debt paydown. So they're done with their debt, long term and short term. Outside of making acquisitions, they might go back into it, but their use of cash now can be strictly reinvesting in themselves and buying back shares that are hopefully cheap. And so let's hope they do that in the future. But it looks like they're on the right track. So sometimes you can see exactly where their investments are taking place. Otherwise, if their capital expenditures go up significantly, then you know that they're reinvesting more into the business to keep the not just keep the business going, but also to expand, go into expanding ventures. And so, uh, solid use of cash. Let's hope in the future they buy back cheap shares and then reinvest at these stupendous rates of return. Let's start making some assumptions here. So on the revenue growth side, I mean, that last 3 years has been absolutely wild. Before that, pretty slow growth, actually. I know the semiconductor business is going to grow, I believe, in the double digits or expected to grow in the double digits annually over the next couple years. So I think that, founded in 1983, I mean, there was some slow growth there. I think a lot of semiconductors just didn't grow very heavy, though. So maybe I'll do 8%. P and price to free cash flow for this company. I mean, maybe 18. I don't see anything that. I mean, they do have increasing margins and good return on invested capital, but there's just a lot of companies in this industry, and I don't know if they are necessarily the leader of that develop and sell semiconductor products. Like, there's so many that do. So I put a premium over the average, the market average, but um, anything in excess, I just don't believe. So margins, I'll do on the upper end of here. I do like that. Free cash flow looks to be consistently higher. Hey, let's do 20 and 25%, 0% share changes. Well, I mean, I guess they buy back a lot of shares, but then they're issuing a lot of shares through stock-based compensation. So that's why we don't see it on our end. We don't see the reduction of shares, even though they are repurchasing shares. They're just issuing them as much as they're buying them back, and then no dividends. So yeah, I mean, it just looks pretty darn expensive to me. Again, if I do just super quick look, 40 PE, consistent earnings. I'm going to 18p. Revenue growth and margin growth does not beat discount rate. It's just expensive at this point. So I do think the company looks good. I don't think they have a long history of looking that fantastic, though, because they weren't making money in 2015 to 2018. But I do think that, recently the numbers do look pretty darn good. And I just think, to me, I make my conservative assumptions based on averages and where I think the industry is going to go and where I think they might be within the industry. And right now, I think they're just kind of expensive. Hopefully you enjoy the video and have a great rest of your day. Thank you.